Welcome back, guys, to
Risk, fees, and taxes. How to reduce risk, fees, and taxes
with
in
Higher Ground Financial Group. Daniel and Raz here, and we want to save you money. It's your money after all. Why not? Why shouldn't you keep it? Why should other people get it? Right?
So let's talk about some things that people often miss when they're planning on diversification. We talk sometimes about diversification in um, opinion-based assets compared to contract-based assets, but there's also tax diversification.
Right. So there's a lot of different ways that you can be taxed. It could be capital gains, it could be income tax, it could be cascading tax effect. It could raise your tax burden and on all your different things is estate tax, gift tax. There's a lot of taxes out there, right? Excise tax, taxes on
Right.
RMD, taxes on inheritance. So
And most people instinctively put all their money or most of their savings into tax deferred things like IRAs and 401ks and TSPs. But that's really not a great idea to have everything in a tax deferred. First of all, tax deferral is not all it's cracked up to be, and we talk about that often on this show. But
so
besides
think about it. It's like you're getting a snowball at the top of a mountain. You're deferring that snowball. It's getting bigger and bigger and starting to kind of get out of your control. It's rolling down the hill really fast, and you don't have control over it anymore.
Exactly. So how do you diversify from a tax perspective? Well, you have your IRAs, maybe that's fine. It's not necessarily bad to have any IRA at all, but you also want Roth IRAs. You can do Roth conversions to make it that way. There's other types of tax-free accounts as well. There's non-qualified assets, which means non-IRA, non-retirement money. Right. This is after-tax investments in stocks
and there's other tax-free accounts, and there's real estate. There's a lot of different ways to diversify your tax basis, because then you can pick and choose how you're going to spend your money to minimize the taxes depending on what the taxes are. Now, one of the things that you might have heard is a self-directed IRA. We hear that a lot. You can just get a self-directed IRA and buy gold someplace in Texas, or you can, hey, I've heard this one. How about you? Do you hear this one? When you have a self-directed IRA and you buy real estate, some rental property, and it's the best thing since sliced bread, because now you have rental property and it's appreciating inside your IRA.
That's a terrible idea for most people.
What?
Yeah,
that's not what I hear on the radio all the time.
Well, we're on the radio too, right?
Oh, yes, right.
Yes, and we're right. They're wrong. No, every recommendation is good for certain situations and bad in other situations. So when we work with our clients, we give you fiduciary advice. This advice here on the radio show that you're hearing is not fiduciary advice for you. It's general information. But it does hurt my heart when I hear people putting a lot of money into a real estate inside their IRAs, because.
So why is it so bad, Daniel? I mean, you hear about this all the time. People, pushing this. Put your real estate inside your IRA. It's the best thing to slice bread.
So real estate inside of an IRA is a problem for a number of reasons. Number one, you have a very high maintenance cost. So you have to have a third-party manager to verify that you're not self-dealing. You have to do several valuations very frequently, sometimes even twice a year. You got to get it appraised.
And you have to have a bunch of money in cash inside there as well, because in case you have repairs.
Exactly. If you have, let's say you have to replace a roof on this house that's in there, you can't just contribute 20 or 30,000 at once to your IRA. You're not allowed to. It's past the contribution limit. So unless you have enough cash in there, then now you got to get a loan. Well, too bad if you want a loan, because you won't be able to get a good favorable interest rate because it's in an IRA. So it's a commercial loan. It's not a residential loan. It's a really big mess. And probably the most important reason that rental properties do not work so well inside of IRAs is the main benefit of real estate in the tax code is depreciation, where you can depreciate that property down to zero, take a deduction without really losing any money on it, and your income is tax-free for the most part. And then when you die, your kids inherit this property with a stepped-up basis, and they don't pay any taxes. Well, all that's gone if you have an IRA, because none of that applies.
It's so you mean tell me, if I put the house in an IRA, all those tax benefits are gone?
All of those tax benefits are gone.
So why in the world would I put it in there?
Well, because somebody tells you that it's a good thing for you, and then you listen to them, I guess. There's again, I don't have an issue with the real estate. I like real estate. I think in many cases it's a great idea to have rental properties as part of your retirement plan.
But not as a landlord, though. I mean, you should have a property manager. You should have to do it properly, because at this stage in life, you don't want to be fixing toilets on Sunday nights when you want to be with your family.
Exactly. So have a property manager, but real estate is actually a really important part of any retirement plan. Mm-hmm. So I don't have a problem with real estate, but I have a problem with real estate inside of the IRA. It should be outside the IRA, so you get all those tax benefits.
So that's one misuse of a tax diversification, right? You're putting something that shouldn't be in an IRA and losing a lot of the benefits.
And when you meet with us, you go to riskfeestaxes.com. You can find out what types of tax strategies you can take advantage of, so you're not making the wrong decision about which tax status to have in your different investments.
So another thing I heard a lot about is annuities. Annuities. When you get older, when you want to take less risk, you really should look at annuities. Well, first of all, are annuities good or bad? And second of all, if I do decide I want an annuity, then should I just go ahead and sell my cryptocurrency or my Apple stock that's highly appreciated and buy an annuity because it's safer?
So let's answer the second part first.
Okay.
So again, because that goes back to taxes. If you decided already that you want to buy an annuity and you're going to sell your stock to do that, well, selling your stock is going to cause a capital gains, which you were not required to pay, but now you're paying.
Oops.
So you do that, and then you buy the annuity. The annuity grows tax deferred, which means someday when the income comes out, it's taxable at income rates, not capital gains.
Oops again.
That's even worse than capital gains. So first of all, you pay capital gains when you don't need to. Later, you create income tax, which is even worse. So you're being double taxed on this money. And there's a better solution, because again, if you were going to buy an annuity and you have an IRA, use the IRA for the annuity. Because did you know that when you buy an annuity with your IRA, it's still an IRA? There's no taxes.
So you don't pay any taxes when you roll it into an annuity. You don't pay the taxes.
There's no tax on that transfer because it's still an IRA. Then when the income comes out, yes, it's taxable, but you have not created any new tax by doing that.
So you just told me I shouldn't put a house into an IRA, but now you're saying I should put an IRA into an annuity?
So if you're going to do an annuity, it makes sense to do that in an IRA for most people. If you're going to buy a rental property, it makes sense outside the IRA. Many people get this backwards. They buy their house in the IRA or the rental property, and they buy the annuity with cash. Again, cash or stocks is not the best money for annuities for tax purposes. But let's go back to your first question: are annuities bad? Because you heard me just say that rental property should not be in the IRA, but I do like rental properties. Mm-hmm. So I'll say the same thing about annuities. Annuities should be in the IRA, most likely. And I do like annuities for certain clients and only certain types.
Yeah, but I've heard annuities, you give up control of your money, and mm-hmm. when you die, all your money's gone.
Well, that's only true of certain types of annuities. And again, it depends on the person and which one is in your best interest. But a traditional annuity, an old-fashioned annuity, is a SPIA, an immediate annuity. It's like a pension. So when you retire, let's say you have a government pension and you retire, you get this pension, and you die the day after you retire, then it goes away. There's no balance to it. You just get it during your lifetime, right?
Unless you got a spousal.
Yeah, then you get a joint pension, but you both die and now your kids get nothing, right? If you live a long, long time, then that'll keep paying you. And that's one of the benefits of pensions, because they give you predictable, guaranteed lifetime income that reduces your stress and helps you be happier in retirement. There's a lot of studies that show that.
So what is that risk that you're taking care of? So the risk of living too long, right? Mm-hmm. Longevity risk is you're transferring that risk to the insurance company, because they're uniquely situated in order to protect you against longevity, because they deal with millions of clients, and some die young, some die later, and that allows them to be able to insure that risk where you as an individual cannot insure it.
So an income annuity like that may be good for some people if you don't have enough guaranteed income already. See, most people would very much benefit by having guaranteed lifetime income, and you have some with Social Security, but Social Security is not usually enough income for most people. So you may want to supplement that with additional guaranteed income from an income annuity. Now, if you are listening to this radio program and you're thinking, well, I have a pension too. I work for one of the few companies left that has a pension, or I work for the government and I have a pension. All right, well, maybe your pension and your Social Security together are enough for your basic expenses. If that's the case, then an income annuity would be a terrible idea for you. So just because you hear some great advertising about, oh, this amazing annuity with guaranteed this and that and bonuses and all that, it doesn't necessarily work for you, because you have enough guaranteed income already.
So one of the things that I really want to point out is there's a lot of ways to sell annuities, right? And a lot of times you have what's called bling. You got a 30% bonus and 10% guaranteed for 10 years or whatever it may be. And why are people using those kind of things if annuity is a good thing?
Well, a lot of people, a lot of advisors, whether they may not understand it properly, or they may think that it's very attractive to use certain features to get people interested.
But if you're getting 30% right off the top. You put $1 million in, now you have 1.3 million right off the bat. How is that bad?
Well, it sometimes can be misleading because the 30% is fake money. It's only used to calculate a pension. It's not real money that you can spend.
But some of them do have actual real principal credit, right?
Some of them have premium bonuses where you get guaranteed a certain amount of interest.
But there's no such thing as a free lunch, right? So
Right.
if you're getting that, what are you giving up?
So usually you're giving up some growth later to do that. So if you have a higher bonus or higher guaranteed amount up front, then you maybe get a lower interest rate later on. So there's a lot of different things to deal with annuities.
So when you get attracted to something fancy and shiny that's getting your attention, then you got to look underneath the hood and see, hey, exactly what am I getting myself into, and where are they taking it back from? Because they're not going to do it for free, right? Nobody gives money away for free.
Mm-hmm.
So annuities have a lot of different levers to pull, and they use those levers. And when you get a bonus or when you get a guaranteed interest rate or a guaranteed step up or any of those guarantees, you're losing something someplace else.
So if you want to make an appointment with us, go to our website, riskfeestaxes.com, and we can evaluate any annuity that you've been presented, and we can give you a fiduciary advice on whether this particular product is actually good or bad for you, because every product is good for somebody, right? It exists because somebody wants it. So it's not necessarily bad to have a specific product, but for you it may be bad, or it might be really good.
Even timeshares, right? Even timeshares, it could be bad for a lot of people, but it could be good for the right person.
I've met some people that were extremely happy with their timeshares, have been using them for decades.
Yeah.
I also know a lot of people that hate their timeshares.
So annuities themselves are not bad. You just got to be aware of all the different things and make sure that you're not paying overly high fees. And variable annuities have a lot of fees, so you got to make sure that you don't have those high fees.
So there, real quick before that we run out of time in the segment, there's three main kinds of annuities that you want to think about and make sure when you're comparing the right kind to itself. So variable annuities you just mentioned, those are in the market. They have extremely high fees, and they are useful only in a very limited set of circumstances. But that is what they are. They're market based. Then there's income annuities, which could be variable or fixed, but their income and the primary purpose is to provide a guaranteed lifetime income like a pension.
And it could be later or today.
Right. And then there are growth annuities or deferred annuities that they grow and their accumulation. And those are best compared to other kinds of safe money like CDs, money market, bonds, things like that, where you're just growing and you may or may not spend the money anytime soon, but you're getting hopefully a much better interest rate than you could get in other safe money, but you have no chance of loss. So those usually do not have any fees at all. So again, for certain people, they're great. For certain people, they may not be so good, but you need to contact us to evaluate and find out what is the best product or service in your situation. And with our firm, we always try to reduce and eliminate risk, fees, and taxes as much as possible. So go to our website, Risk, Fees, and Taxes, and we'll help you with what is in your best interest.